following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are everyone's favorite bi-weekly source for some options information. At least I hope we're your favorite. Otherwise, what are you doing tuning into us? But of course, we thank all of our listeners for tuning in, even if indeed we're not your favorite. We'll take second favorite. We'll take even third favorite. We're not picky over here at the old Option Block. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to refer to around these parts as the Options Insider Radio Network, upon which many of you are probably listening to this fine program right now, or if you're not, if you're out in some other area, or you're downloading via RSS, you're one of the hardcore folks, we love you guys too, or you're streaming from the website or a lot of other great places to find this show. We'll take you all. We'll welcome all of you into the very wide and broad Option Block tent. Of course, that tent is a little bit smaller today because we're sans one co-host, but don't worry, the show won't be any the worse for wear. We'll all pick up the slack, starting off with the man beaming in from the great state known as Maine, a.k.a. the Lobster Kingdom. He is the Rock Lobster himself. Good old Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the show, sir.
It is great to be here as the only resident rock lobster.
I know Sebastian likes to break out into song. I think that's the first time you maybe have broken out into song on our panel here.
You know, I don't have that. I have kind of a nasally, annoying voice as opposed to Mark's more staccato, maybe slightly entertaining voice. So I don't sing as much.
You're also probably the first person I've heard to actually praise Mark Sebastian's voice. So there we go. I think even he will describe it charitably as shall we say, tinny.
Tinny. I try to come up with some more opera-sounding type word.
We have to add the deep bass filter for him whenever he comes on the show to make him sound a little bit more man-like. We hit the Sebastian button.
Always, you know what your listeners always get with the Option Block? Humor. They get humor. I don't know if they're going to learn anything, but they get humor.
Quality. This is gold material we're bringing to you for free, listeners.
We throw nuggets at you through your iPad, hitting you right in the forehead.
You'd clearly pay tens of cents for this elsewhere, but you get it for free here. So be thankful. Be very thankful we're not charging. All right, and rounding out our panel today, the man with the fanciest of hats. Some know him as the Viceroy. Others just call him Mr. Alex Jacobson from the educational arm of Options Express. Mr. Alex, welcome back to the show, sir.
Hey, Mark. Good to be here today. Lot to talk about today.
Yeah, it was an interesting one. So I think without further ado, we shall get started.
The Trading Block.
All right, those bells mean that it is time for the trading block. Of course, the portion of the show where we break down the day's worth of trading activity and action. It was a bit of an interesting one today. We saw a bit of a rise buoyed by some strong economic news, but looks like we tapered off toward the end of the day. The S&P had been up to close to about 0.5% during the earlier part of the session, closed up fractionally up about 0.25% on the day. NASDAQ up nearly a full point, 0.8% on the day to 3620. Good old Dow essentially unched up fractionally on the day, up about 16 handles to 14,841. Of course, amidst all of that, even with this broad uptick, we saw some the VIX cash creeping up as well, up about 1/3 of a point to 16.82, staying strongly above that 16 level. You know, back on our show earlier this week, the Tuesday show, we talked about the breaking news that was coming out then about Syria and some of the international turmoil and how that was going to affect the markets going forward. And clearly that's still being, the ramifications of that are still being felt throughout the marketplace. We're seeing vol continue to creep up. We're seeing a few interesting developments. This is normally a scenario where if everything else was equal, we're going into a holiday weekend, we would have already seen a lot of this vol come pumping out of the market. And clearly some of it has, but certainly not to the degree that I think we probably would have expected, all other things being equal going into Thursday, coming into the last trading session of the holiday week. Mr. Andrew, would you concur with that? Is the vol not creeping out perhaps as fast and as steady as you expected prior to the Syria announcement earlier this week?
Yeah, I have to say, no, it's not. It looked like they were trying to take it out this morning. I mean, on Monday before the Syria thing, the SEP 06 IV at the money was 11.10, about midway through the day. And I thought they were starting to decay it already then. Then the Syria thing comes out. I think by the end of the day it was trading 14 and change, and then by Tuesday 16 and change. Today volatility was only down. I'm looking at a tick now, only down like 28 cents. So actually, I think for a point there today, they put the vol back in. The stuff expiring next Friday. So yeah, I agree 100%. They definitely did not take the vol out, and I think. They are going. I think we could see a pretty good, a little tatering tomorrow. But I think part of the problem was, the president went on NPR, national or PBS, and said, "I haven't made a decision." Like at the beginning of the week, those chemical weapons, we're going to do something. And now I haven't made a decision. So I don't know if it's like a rope-a-dope type of thing where he's lulling them into a false sense of security. But from a vol point of view, the market...
Presidential rope-a-dope. I like that.
Presidential rope-a-dope.
Is that how foreign policy...
That's what we call the show today.
Is that how foreign policy plays out in your world? I like that. Kick them up against the ropes a little bit, then you sucker punch them, and you're done.
Exactly. And that's what I wrote today in our blog. Essentially, there's like a vol fatigue where there's really not much movement in the market. You had the one day where everybody kind of freaked out, which normally happens when we talk about going to war. There's always the freak out. But we're maintaining volatility levels. At least the VIX futures levels are at those highs right now, and they have not come in one whit. So, pretty extensive, like something might happen this weekend, maybe. I'm not quite sure, but it's definitely up there.
We joke about it a lot on this show about weekend risk. This seems like one of those weekends where you have quite literal weekend risk.
I think you do.
A lot could erupt.
The thing is probably it's going to be, okay, something happens, and then, whew. I thought it was going to happen in oil, and then the fact that, when he says, I'm still deciding, what is that, 1 week, 2 weeks, 3 weeks now? I thought it was going to be a week, it was going to be severe and swift, and now it's not. Or maybe not. Again, he's rope-a-doping us.
The other thing to keep in mind is next week is a funky week from a trading standpoint, because not only do you have the holiday on Monday, but you have the Jewish New Year Thursday and Friday, and that's going to keep a lot of Wall Street home. So in a sense, you only have a couple trading days next week. And I wouldn't be surprised to see people going home with vol premium this week just with the expectation of, as you pointed out, Andrew, the uncertainty coming out of the Middle East and the quiet week next week. If you watch news services last night, I moderate our OX Social site generally till about 11 o'clock Chicago, and one of the things I do is I keep Bloomberg on and I watch news services. And there was this news flash last night that it was not factual, but that the Egyptians were closing the canal to U.S. Military ships as part of their mutual defense agreement with Syria. And of course, you see a news flash like that, and the first thing you do is you try to check other resources to see if it's true, because a lot of that stuff goes up and is rag speculation or sometimes just fiction. But that's the kind of stuff that's going to be going on, and you're going to have a short trading week next week. So yeah, I would go home with some protection.
Yeah, this seems like a classic scenario for having a few puts in your back pocket for a rainy day here. I know a lot of our listeners tend to lean towards the premium selling side of the fence. I know a weekend like this and the chance to capture all that decay, the chance that it hasn't come out yet, it could be pretty attractive to you. You may be tempted to lean toward the dark side. I don't think this is a weekend where you want to go out with a lot of net shorts. If you are a premium seller and you can't keep your hand from hitting the bid for whatever reason, then perhaps you definitely want to work spreads. You don't want to come out blasting naked options left and right like some of you still clearly love to do. You definitely want to have some defined risk on a weekend like this, because you never know when the cruise missiles might start raining down or whatever else, boots on the ground. That would certainly be a turn for the worse. You never know what's going to unfold. And as Alex pointed out, we do have a bit of a funky week next week as well. So with thin days towards the end of the week, maybe it isn't a bad time to switch, go to the light side for a change, put some premium in your back pocket, or at the very least get some free juice, as Senior Andrew is always espousing here.
Yeah, and I think we'll see if they actually take it out. I don't really know. As far as we looked at some time spreads and just some trades today with a little bit of room in them. Maybe they take it out tomorrow, but I don't think they took it out today.
Yeah, it will come out, obviously, but whether they wait till the very last minute, and probably won't come out as aggressively as we have seen in weeks past, where they'll roll it to, sometimes late Tuesday, if not early Wednesday levels. Instead, they'll probably keep it relatively, I think, modest, the time decay. And that should tell you something in and of itself, because market makers are never hesitant to crush a bid and avoid getting that time decay rammed down their throats. And so if they're hesitating this week, then perhaps you should as well. Good. You never went broke not selling something.
It's amazing that, you know what? It's amazing how much money you save not losing money.
There we go. So many titles just floating around for this episode today.
I'm trying. I'm trying my best. I've got my thinking cap on today.
There we go. I like it. At least one of us does. Alex and I are still in some crazy fog from all that Maine lobster we've been enjoying, thanks to your care package.
One day I will send you guys out a care package.
Andrew is nothing if not beneficent, dear listeners, so keep that in mind as the show progresses. And he turns toward the dark side there in the odd block. But we haven't gotten there yet. We touched on the VIX. Of course, commodities having a bit of a downturn as well. Of course, not surprising given everything we're seeing in the global macroeconomic spectrum there. Gold and oil taking it a bit on the chin today. Looks like gold finishing down about a little over 0.5% on today's activity. Of course, that could be just some profit taking as well. We have seen a bit of a run-up in the metals of late, so people taking that off the table as well.
The euro got beat up today based on the German employment news, too, which I think was a little bit of a surprise because everybody was talking about how much better Europe looks. And today the Germans came in, and the Germans are the engine driving Europe, came in with disappointing employment news. So that, again, has got to lend some concern to the weekend and the next trading week.
Yeah, I think Europe has been kind of the 2 steps forward, 1 step back thing. Yes, it's not. It's amazing how that economy is doing better than we thought, and mostly because it's not imploding. Like if they're structurally going to break the euro up, that just messes everybody up. Nobody can do anything. But now that the euro is holding together, and the governments amazingly are spending less money, it is working probably a little better than everybody thought, but it's like our economy in a way. You're not always going to get that great. Not every report is going to be great.
Yeah, and you know what? The last couple of weeks, I mean, if you go back a month or two ago, we'd be weak in the morning and strong in the afternoon. And, I was always taught that the morning is influenced by Europe because they're open, and the afternoon is Asia. And we talked about the macro case, why Asia was coming in and buying low rates, no returns in their domestic market. Lately, we've been strong in the morning and disappointing in the afternoon, and I just don't like it. That market just doesn't look like it did a month ago when, there was no stopping it. And now with the political news and tapering and Washington coming back, somehow it seems nobody wants Washington to reconvene. But with all that stuff, our afternoons have just been really disappointing. I mean, the sell-off today was pretty much in the last hour or so.
It's all the easy catalysts, you're right, Alex, are gone. Like the QE, I don't care what anybody, the taper's done, right? They're going to be tapering. You have 2.5% economic growth. So you have to go back to the market going up on fundamental, the old school stuff. And it's it's hard for us to have positive catalysts and when there aren't any positive catalysts. So it's the market rallies, I think, are just going to have a hard time. And all of a sudden now you can get 2.7% on your 10-year T-bills, everybody's thrilled because their income just doubled. So I think it's going to be harder for the market now to rally overall. This Obamacare is coming out. There's all this. There's not a lot of really good news unless the government can actually. What I think helped most of this rally was the actual fact that we could trim the deficit so fast, and then the economy could still grow at a modest pace, as opposed to Europe, who tried to trim deficits, and all those countries imploded. So I think that says a lot for the system that we have, but it also probably is the rally killer that we have as well.
Yeah, it's a good point, Andrew. The investing public tends to eat off the short rate. The firms tend to eat off the longer rate, and short rates are still, for round number purposes, nothing. So in some sense, that's some floor here in the market. Quantitative easing, it's clear the Fed is sensitive to what it says. And to your point, Andrew, yeah, it isn't going to be $85 billion, but it isn't going to be nothing either. And
right.
And if you look at, what a lot of folks who focused on the Fed are saying is maybe it won't be December, maybe it won't be till December, but I was editing a piece today on trading psychology, and the first thing is, never fight the Fed. The Fed is still going to be accommodative. They're not going to pull it out. But to your point, Andrew, the move in the 10, the 100 basis point move in the 10 potentially has a bigger impact on housing than anything else. And you can already see housing numbers which are real hard to discern, because everybody's got a spin as soon as they post Case-Shiller or housing starts. But housing survives off the 10-year. And, mortgages are now bumping up in the 5% area, which, when you and I were growing up, Andrew, that was still cheap money and we would have killed for it. But for this generation, that starts to be expensive money. And the two engines that drive the American economy are housing and Detroit. Detroit is running 3 shifts. It's amazing. There isn't a day that goes by that there isn't a new Ford is adding a 3rd shift. Ford is opening a new plant. General Motors is selling capacity. Even Chrysler's doing well. But housing is going to be kind of a wild card here. And if that 10 pops more, and we've all talked about this, kind of laser focusing on the 10. If the 10 pops more, I don't know what that's going to do to the sentiment in housing. I don't know any real housing number that's any good. And And when I grew up in the business, before Case-Shiller and a lot of this stuff, the housing number used to be, are you short plywood or are you long plywood? Because that was the kind of best product you could trade that reacted to housing starts. We'll see. I think a lot of this is going to be what comes out of Washington, and I fear a lot of this will be what comes out of the Mideast.
Now, you mentioned the two twin engines that are driving our economy there, Alex, and I think a lot of people would point to two of the twin engines that are driving the financial marketplace a lot these days are the HFTs and the algos that have been causing a lot of Sturm und Drang here in the equity marketplace, less so in the options marketplace, and perhaps to a similar degree there in the futures realm. There's been a lot of debate, and we haven't jumped into that much. I know the HFT is kind of labeled as this great big boogeyman these days. A lot of outlets really love to bash it. It's a very popular topic, is HFT evil, all these flickering quotes. How do they impact the marketplace, things like that. We've touched on it a little bit here on the show, but not to a great degree, because there isn't, quite frankly, a lot of data on it. And that changed a little bit yesterday when our friends over at FIA, that's the Futures Industry Association, they did a study on the impact of HFT and algos on their side of the space, the futures side of the space. In particular, they looked at Eurodollar futures, the E-minis, light sweet crude oil futures, the 10-year futures, DAX, a pretty broad view, Brent crude, Russell 2000 futures, sugar, a variety, 3-month Euribor, a lot of different products, 15 major popular futures contracts across a variety of products, and to see what the impact really was of HFT and these algos. And it wasn't the FIA guys doing it, in case you're wondering. They have an axe to grind. They contracted the guys over at Vanderbilt, Robert Whaley and Nicholas Bolin, to do this study. And it's an interesting study. I encourage you to read it. You can read the salient data points there on our website, on theoptionsinsider.com. We, of course, will link to the full results there on the FIA site if you want to dive into that a little bit yourself as well. But in conclusion, after looking at all these different products across these variety of different cycles, they found that while prices in these 15 markets move through cycles of high and low volatility, as well as numerous price spikes attributable to macroeconomic events, there, no surprise there, of course, volatility attributable to structural factors did not change in most of these contracts. That's a lot of verbiage there, but what they're saying at the end of the day is they couldn't find really any demonstrable impact from any of these people coming in, HFTs, algos, what have you, and really demonstrably changing what would consider to be structural, fundamental volatility in these products. And this is some of the first data we've seen on that. Granted, it's on the future side of the space. I don't know how many people who are really beating the drum that HFT is destroying the futures realm. A lot of the big futures stuff is still locked to the pits. It's still very insulated from those HFT and algo guys, but they're becoming more active in that space. So it's interesting to have some data on that. It'd be interesting to see how that stuff correlates to what we're seeing coming out of the equity markets. And I'd imagine a lot of this correlates to what we're seeing in the options realm as well. Despite all despite all the noise we're hearing about this stuff, it hasn't really seemed to penetrate into the derivatives realm for a variety of reasons. These products are more complicated. The liquidity is a little bit different. It's more difficult to flash in and out of these types of products. It's certainly not the same thing as flickering in and out of an underlying equity. And a lot of these guys who are trying to take that approach and bring it to options and to futures, I think they're discovering that to their great dismay. Andrew and Mr. Alex, did this study come as a surprise to you? I'm guessing that these results are pretty much in line with what you guys expected as well.
They're smart guys. I totally respect the study, but, and this is the big but, in the futures industry, you don't have as much rebating as you do here. A lot of the high-frequency stuff and a lot of the algo stuff was designed to capture rebates. If you look at the P&Ls of the high-frequency firms and the algo firms in the securities industry, their P&Ls have gotten crushed in the last year or two, and I think it's part of the reason our volume is down. And our business is evolving, too. I mean, we talked about this on last week's show, where you're seeing consolidation amongst the exchanges. This industry is going to evolve again, and the options industry had the big evolution in 99, 2000, 2001 era when you had the option-centric firms starting, multiple listing, and payment for order flow. And then you saw the options industry flourish off the high frequency people in the 2007 to the 2010 era, and now you're seeing consolidation. And the industry may look very different on this side. A year from now, there was a story yesterday that Gemini already had a 2% share, and it was Gemini is the second ISE exchange. And the thing is, if you look at Gemini, it's a maker-taker model. And there are clearly lots of liquidity providers that will make bigger size if they're getting paid to do it in a maker environment. I think we're going to evolve again here, and I'm not sure what this industry is going to look like on the other side. But, I'm somewhat concerned. My own view, and let me emphasize it's my own view, that we kind of sold out to the HFT people, and we saw huge volume numbers, and now the model has changed, and they're not as active, and we're seeing thinner markets. Everybody who trades in this industry always makes the claim that they're valuable because they add liquidity. And I think what goes on in futures where there's no rebating is much different than what goes on the security side, where people build trade engines just to capture the rebate. And to your point, Mark, those were the flashing quotes. Arguably, those have been kind of some of the flash problems. I don't want to say those were the problems in the flash crash, because I'm not sure that's that clear yet, but we need to figure out a business model that works, and we're evolving again now, and it will be interesting to see what our industry, what the options industry looks like on the other side. It's been real inexpensive to trade from 2000 to now, and it's getting expensive to trade again, and I don't think that bodes well for our customer, who's the individual investor.
I agree with just about everything that came out of your mouth there, Mr. Alex. So you're right. We've seen a lot of people. If there is much HFT penetration in the option space, we used to joke on the show back a couple of years ago that Citi was a big example of that. It was a $4 name. People were just flashing it back and forth, trying to do exactly what you said, to capture that rebate arb. And we have 12 exchanges in the option space now. Everyone has a different fee schedule. So if you sit down and do your homework and create an algo that opens at one exchange that pays you a rebate of 35 cents, and then you close on an exchange that costs you less than that, there is a profit differential to be captured there. Of course, there's a risk inherent in that as well, but still, that is where a lot of this stuff has gone on the option side. And that's why I was kind of surprised when I saw this headline pop up that it was attached to the FIA, because I have yet to hear anyone lamenting the impact of HFT in the futures realm, precisely for the reasons you described, Alex. It isn't a rebate-centric place. There's one exchange for the most part. There are others, obviously. There's ICE and there's other players out there, but there's one monolith that dominates a lot of the volume, not exactly fertile ground for trading in and out and capturing fees. So it surprised me to see that they were getting front and center on this. Maybe they want to say, hey, look away from us. We don't have this problem. Maybe there was some of that as well. Still, I thought it was interesting, and we don't see much in the way of any data on this stuff, let alone from the futures and vol perspective. So I thought it was kind of interesting. I would love to see a correlating study on the equity side and then the equity option side and see how much that actually impacts it. I think it would be interesting. So a lot of the names would be nominal, but some of these smaller names with these guys like to flicker in and out, and they can capture the rebates a little easier. I think it would be a significant chunk of the paper that has been going up out there. So interesting stuff. And I think now it's time to keep on rolling into more interesting stuff, aka the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. This is, of course, the portion of the program where we break down some of the interesting and perhaps slightly dubious activity we see lighting up the old tape. We're going to kick things off today with a bit of a recap, a reinvestigation, if you will, of some activity we highlighted last week on the site, and I'm not sure if we talked about it on the show or not. I might have come up in between episodes, but it was some calls going up in Gold Resource Corp, ticker symbol GORO, GORO. They closed today $8.67, up about 41 cents or about 5%. So a good day for them. When we wrote this up last week, this was trading about $8.50, so it's up a little bit since then. At the time, and one of the reasons we're hitting on this is because we were talking about gold being down today, and yet GORO having a good day to be in the gold resources business, apparently. And we were profiling at the time the SEP 7 halves. They went up in a lot of about 1,000 contracts. And it looked like because they were lifting offer in two 500 lot blocks, actually not lifting offers, but very close to the offer, it seemed like these were closing, particularly because there were 1,400 contracts open on the strike already. But fast forward, so it looked like someone was buying back a short to close it out. But fast forward a week, and we look at the open interest numbers now, and actually there are 2,400 open on that strike. So clearly that was some opening long paper, and this guy picked them up for $1.20. Those options are now trading $1.25 at $1.40. So far at least, this guy seems to be on the right side of the vol train. Mr. Andrew, is that your take as well?
Yeah. What I do is I go back the next day and check on the open interest, which for any of you listening to, that look at just some of the odd block trades and things like that. That's always, it's always good. If you're going to look at a stock, especially some of the gold stocks, because they've had, the miners have had this big or are bouncing heavily. This is to buy a 7.5 call. Is he buying it to exercise for the divvy? I mean, it's only a little tiny divvy, so I don't know why you'd pay 20 cents over parity to collect like a 3-cent dividend. But
I would do that all day long, sir. Great trade.
It would make a fortune. But it looks like I wanted to see if he was adding, and sure enough, the open interest is getting larger. So. Another thing that got me to look back at this is now once it gets on my list, implied volatility hit like a 52-week high in there. So, I think that's mostly just buying paper, buying it up, and another sign of some of these little gold stocks maybe making a rallying. So, I just thought we would circle back on this, and I think it's a good. Looking at what people are interested in, sometimes it, again, just generates an idea, something that might be interesting for you. And, full disclosure, I'm long some of this gold stock stuff. Not this particular one, but.
That was your 1,000 lot. Admit it.
Exactly.
You're writing up your own trade.
I'd love it to be mine. Love. I will take any in the money trade all the time.
You were pulling a Carl Icahn. Hey, I just bought some of these. Why don't you buy back more of them? That's not a pump and dump, sure.
But again, just taking a peek at an old odd block trade as we roll into maybe some new stuff. But
yeah, we like to look back here. A little bit of navel gazing every now and then doesn't hurt, particularly in the realm of unusual activity, because that one had all the hallmarks of being closing. It's a very low volume name, doing 2x its ADV in one essential trade, 1,400 contracts on the strike, not many open on the other strikes around it, seem like closing in every respect of the word. And that's why we say sometimes, at the end of the day, listeners, you really don't know what's going on with this. When I did a little research into that one, I was kind of surprised as well to see, hey, this actually was an opening trade. So at the end of the day, you never know, which is why it's kind of fun to parse this stuff. And now we're going to dive from the world of gold into the world of buggy whip manufacturers. Oh, wait, I'm sorry. Standalone GPS manufacturers. Same thing. This is Garmin, ticker symbol GRMN. They closed today. Actually, a good day for buggy whip manufacturers. They were closed at 41.23, up $1.72, or about 4.5% on the day today. A lot of love going on out here in Garmin. This is the name, too. Usually doing about 1,500 contracts, doing about 14x that, nearly 20,000 contracts going up in Garmin today. So just some size love across the board here for this name, at least from a volume perspective, not from perhaps a directional standpoint. In particular, we saw a lot of activity focusing here on these SEP 41s. Like I said, this is the name that does about 1,500 contracts a day. We saw 2x that going up on this strike alone, including a block here that went up a total about 3,000. Yeah, 3,300 on the day. It looks like they were pretty much blasting away on these puts, hitting the bid on most of these trades. Was that your take as well, Senior Andrew?
I mean, the volume was just, I watched it. They just whacked puts all day long, and there was no open interest. Wouldn't you find that even Alex is looking at this going, okay, if you're selling the 41 puts aggressively, they started selling them like at $1.33. I think the big block went up at like 82 cents. And now they closed actually a little higher, 106. But pretty aggressive long position, just selling a bunch of those things like this, with all the stuff going on in the market and everything else. So I found that an extremely aggressive put trade, I have to say.
Yeah, the thing's rallying, and this guy is obviously clearly drawn a line in the sand here saying, hey, 41, I don't see any stock going up with this or anything like that. So it looks like it was, yeah, exactly. This one, unlike what we just said, this one seems to be exactly what it appears to be on the surface, blasting out some puts for some aggressive levels here. Looks like we got looks like a 25, 26 vol here in the front month in this name. So nothing exuberant, but not cheap either. And these things have about 3 weeks to go, a little over 3 weeks. So an aggressive trade, certainly, especially given the fact that these were in the money puts earlier today. So I don't know. Maybe this guy, maybe this guy was doubling down the bull, selling puts and buying stock and driving it up. I don't know. Either way, interesting stuff.
That's an old school trade.
Yeah, exactly. That's the other way.
Able to do that, not anymore.
Yeah, kind of hard to do that these days. But interesting stuff nonetheless. And again, pointing out in and of itself, just someone drawn a line in the sand in Garmin. I don't know. I didn't look at the news today. What they did that was lighting up the tape. What is going on at Garmin that's getting everyone so excited, given the fact that I think everyone can pretty much declare that the standalone GPS is the next big technology to kind of go the way of the dodo. So unless they're getting into more of the watches, their standalone apps, I can't imagine a standalone app business is going to be anywhere near as lucrative as the GPS business was. But c'est la vie. Perhaps I'm missing something. Clearly I am, because the rest of the market loves Garmin. So I'll have to dig into this trade a little more and see why there's so much love going up in Garmin. Meanwhile, going back to yet another name on the technology front, a name we haven't checked back in a while, but used to be an odd block favorite. We haven't talked about it in a while. Good old Taiwan Semi, ticker symbol TSM, closing today $16.67, up about 41 cents or 2.5% on the day. This is the name that does, about 1,700 contracts and did substantially less than that today. Did about 1,200 contracts today. But looks like pretty much the bulk of that activity, let me see, it might have been all of it. About 2/3 of that activity came in these OC 17 halves. We saw about 750 of them going up, scattered size in a bunch of different blocks. It wasn't one big block. And again, looks like someone really wanted to get in here, either to close or just to put on some love, because this guy was lifting offers here on this OC 17 half strike. What of this one really caught your eye, aside from the fact that it is a substantial portion of the ADV in this one trade alone?
Exactly. I mean, the thing was, it was just, now there was some volume in the SEP 17s too. I mean, I know we're not talking a huge volume, but it's less than 1,000 contracts between the two. But in a not very actively traded name, when paper is just buying a bunch of out of the money calls, either they're kind of trying to get a bounce in the emerging markets, an emerging markets bounce, something like that. But why the heck are you buying the 17.5 calls in Taiwan Semiconductor? It's like an 18 volatility stock. I mean, it's lucky if it'll ever get up there. But again, it had a 41 cent move today, and just paper lifting the offer for a bunch of calls. So I always find it strange when you have kind of a sleepy stock, and then all of a sudden paper just miraculously wants to buy the out of the money options. Let's say it was just strange, to say the least. You just don't really see it. And just a lot of small blocks, just continually lifting the offer, paying 35 cents the whole time. Not putting a bid in for 30, just 35, 35, 35. So it was the nature of the buying that I found a little surprising. In a day that was kind of, let's just say it had some kind of dark-esque overtones to it. I felt it was a pretty go-go purchase.
I think what it really was the SEP OC 17 half 1/5 time spread. That's what it was. Time ratio.
Exactly.
That's clearly what happened here. This is a very, very savvy trader here, loving the TSM a little bit. Interesting one. Of course, we could point out that is the one strike with the most open interest anywhere here on the board, so about 3,200 contracts. So it could be closing. We'll have to wait until tomorrow.
Yeah, I mean, that looks like a buy right. Would you want to buy your 17.5 back for 35 cents for the dollar to go?
I can't, but I can often say that for a lot of the things I see here in the odd block that I don't like any of these trades, which is why we like to profile them. Of course, this guy could be getting spooked. He sees it's up 2.5% today. He's like, wait a minute, I'm on the wrong side of this train. I'm short 3,200 of these things. My risk manager's calling me up. I need to take a third of them or so off the table. Let's try to buy 750 of them back and see what we can do. Stranger things have happened in the odd block, that's for sure.
Yes.
All right, and that's going to do it, at least for now, for the odd block. But we're not done with unusual activity, no, because we're going to keep on rolling right on into the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and first up, I'm going to mix things up a little bit because we were just doing unusual activity, but I wanted to save one of them for the mail block because we just have some questions coming in about this particular alert on our site, so that was a good chance to kill two birds here. So we're going to finish up the odd block and actually in the mail block with DG, Dollar General. Closing today, unched essentially on the day, down fractionally to 54.37. This is the name we've talked about a few times in the past. We've always joked Uncle Mike loves his dollar stores out there. This is the name usually doing about 4,700 contracts, doing about 8,400 today, including a lot of love flocking in here on the SEP 57 halves. Very aggressive here. We saw a total of 5,000 of these going up on the day on open interest of 3,700 contracts. Looks like it went up pretty much as a large block, although it was posted through the bid, so that usually indicates someone is selling. Of course, it could be out of sequence a little bit too, but usually that's a seller, someone taking advantage of this uptick in vol for a better sale. Now, I'm going to get to that in a second, Andrew, because let's hit on this now, because you wrote in the alert on the website, and listeners, if you want to read along, you can, of course, go to theoptionsinsider.com, search for calls, trade, and DG. You can see exactly what we're talking about. But Andrew wrote this one up for us today, and he wrote, the volume traded as a large block through the posted bid at the time. The volume is opening paper and most consistent with a buy-right type of position. The seller could be using uptick in volatility going into earnings for a better sale. The trade drove down the IV and SEP to by about 1.8 points today. And no sooner did that article go up on our site than we had someone writing in on our site. I love the fresh feedback. It's always fun when we get that. And he wrote in saying, I've been watching Dollar General for a while. What do you mean by the seller could be using an uptick in volatility going into earnings for a better sale? Mr. Andrew, why don't you walk our friend here, Mr. Mike, who posted this on the website, what you meant by that?
Sure. So the idea is you've got earnings on the 4th of September, and the SEP cycle will basically that what we call that option cycle will cover the earnings. So the volatility generally should rise in the September options. Now, what happens as the volatility rises, the value of the option goes up more and more and more. And I was looking here at the Vega number for volatility here, and I'm just trying to pull up a number for you in Dollar General. But essentially what happens is if let's say you're a buy right or you're a long-term holder of stock, you can sell your out-of-the-money calls for essentially better prices than you might normally get. So right now at a 37 volatility, you're getting probably about a 50% premium to where you normally sell calls on a 30-day basis in Dollar General, which is pretty good money. And here let me just pull up a Vega per strike. You're getting normally it trades around a 26 vol. You get to sell 36, so that's 10 volatility points. So in dollars, you basically get an extra 50 cents for selling that option with 3 weeks to go. So, the stock is close to an all-time high, or at least a one-year high, which I think is probably close to an all-time high. And, maybe a long holder's like, hey, I will sell the 57.5 calls here. I'll take $1 and, go buy my wife a new Tesla. with the money that I made from it. So.
Yeah, this looked like it was tied to stock. So, of course, when you have a buy right, listeners, then you're buying stock, you're selling call. Of course, what are you doing? You're short a put. So it's not exactly the perhaps outright bearish sentiment you might think it is when you first see these trades going up. But a great question, Mr. Mike, and one we like to discuss whenever possible here on the old unusual activity / odd block, because, or in this case, the mail block, because it is an interesting one. And like I said, just someone looking to take advantage of a nice little earnings pump in vol to get a few extra Teslas for the old wife. I like to do that all the time. I'm sure you do, Andrew, as well. You can never have too many Teslas in the garage, I've learned.
No, everybody's telling me it's a pretty cool car. The problem is I don't think you can drive it around in Maine. I don't think it works. It looks too good on a dirt road.
You got to drive all the way to Boston to charge it up, so it might be kind of hard.
Exactly. There's one charging station in Maine.
We got a couple other great questions here. First off, I got one here for the Viceroy. Alex has your name written all over it. It is a question from Tim C. He writes, is it true if I sell a time spread that OX will margin me as if I'm naked short the longer term option? Remember, selling a time spread, listeners, simple horizontal. Let's say you're selling the longer term option, buying the nearer term. Mr. Tim C goes on to write, if so, I don't understand that. Why wouldn't they treat it like a spread until the nearer term option expires? Interesting question, Alex. We see a lot of people writing in about this topic of margin now as the listeners and the traders in general are becoming more sophisticated and realizing that how this margin is calculated demonstrably affects them and their trading. So why don't you walk our listeners through how OX would treat this simple time spread example and why they do it that way?
Okay, so first of all, it's a good question, and the listener is correct. We will margin it as if it were a naked short option. And let me kind of walk through why that is. All time spreads can be thought of, and this is not a term that I use. This is a term I was taught years ago as a forward starting option. So in this case, what you essentially have is a forward starting short position. And the reason we're going to margin it as if it's short for the entire period is threefold. First of all, number one, remember, margin is not about protecting the customer, it's about protecting the firm. If we treated it as a conventional spread and let you carry it without margin into the expiration of the long position, think about the dilemma we have as a firm then. Your long position is going to expire on Friday. If the market gaps on Monday, you're going to leave us with a large unsecured debit. So if we didn't margin it as a short position, we would in fact have to get with you and have you trade out of it on Wednesday or Thursday of the expiration week of the long. And candidly, that becomes a nightmare because what happens is customers just hide. They simply hide. There's also a suitability issue. If, in fact, you're going to enter into a position which, in fact, could potentially come a short option position, and you don't have the money to margin the short option position, I, from a suitability standpoint, should have thought about why I allowed you in that position in the first place. So it's probably a longer answer than you wanted, but yes, it's correct. And yes, you will be margined as if it was short, because in the end, all it really is a forward starting short option.
That's why I love having you on the show, Alex. You bring up this terminology that, I've been around for a while and I've never heard anything called a forward starting short. So I love that. A little bit of insight into the earlier days of the biz, if you will. But no, Mr. Tim C., this is not unique to OX by any means. If you go to pretty much any broker, they're going to do the same thing. It's pretty much just par for the course. So it's not like OX is somehow uniquely ripping you off or anything like that. This is just how it's done in the business with these forward starting short positions. My new favorite term of the day, my word of the day calendar. Thank you, Mr. Alex. And last up, we have a question here from A. Vega. And Andrew, this one has you written all over it because you are quite the devotee of the back spread, me not so much. He writes, why would I ever trade a back spread? Why waste money on a reverse ratio, let's say 3/2? Then I'm just net long one contract. Can I just save money and buy the one? Mr. Andrew, I know you love back spreads. You go on about them all the time, ad nauseum. Sometimes I have to mute you because your love of the back spread is just so profound. So tell us, sir, why you love them so much and why Mr. A. Vega should change his mind about back spreads.
The thing I would say is with a back spread, if you price it right, like say for credits, that's what I like generally, credits or even. What it gives you is if everything falls apart, you actually won't really lose any money. If you buy one call and you wake up and you have let's say a Syrian invasion, for instance, all of a sudden you're down half your capital is cash in your option is gone. So a back spread gives you a little more flexibility. And that's really the basic, that's, to me, that's the basic reason why you want to trade one of those. I think one of the key parts, though, is you need to have some time to let it work out. If you do it with sort of a short ratio close to expiration, they don't work out very well. Right.
Andrew is spot on. You lose less. I'm sorry, I cut you off, Andrew.
That's okay, but you're keep going. I mean, you are the viceroy.
So think about this. When George Soros took the Bank of England for, I forget what the number was, $4 or $5 billion, he had $400,000 of risk on in a back spread. Now, I know some of you are saying $400,000 of risk. I can't afford $400,000 of risk. But think about the scale. If you put a back spread on and you're absolutely dead wrong, you don't lose a lot of money. Now, how much is a lot of money is relative to everyone. But you get the leverage of the options market. You get a position where if you're wrong, you don't simply lose a lot of money. And I know a lot of people, going back to my youth, whose attitude in the options market is it's not how to get rich, it's how not to get poor.
Exactly.
And the thing about back spreads is every once in a while you'll get a move where a back spread will make you just a bag of money. Just a bag of money. I mean, if Syria blows up this weekend, if oil goes to $150, right? But you say to yourself, if I'm wrong, I won't lose much.
Exactly.
And when I get these big moves, when I get these events, oil, when it went to $150 back when I called on hedge funds, I had a hedge fund client that had a back spread on an oil with, get this, almost no risk. Now, they didn't put it on all at once. They legged into it. They evolved into it. So it had risk along the way. But when oil went to $150, their profit on that trade was probably the gross national product of the state of Illinois. Right. It's probably a little bit of an exaggeration, but
not much.
They just made a bag of money without a lot of risk once they got the trade set up. I'm not saying they didn't have risk as they legged in, but it's a really cool trade. And in many ways, of all the things you look at in the options market, 1x2s, 2x3s, they're your repair strategies, they're your benefit from a big move in the market. And I know I use this word a lot, but they are really cool. And when you can set them up right, if you're 100% wrong, you don't lose a lot of money.
I love this question because it comes in some various form all the time. And I wanted to bring it up on the show because I know Andrew's such a big fan of the back spread. But I think a lot of people just think, oh, it's 3x2. I'm just paying as much for that extra one as I would have if I just went out and bought it outright. And that's clearly not the way to set it up. If you're doing it that way, then you are doing it wrong. And you're right. There is no reason to do it.
Right. It takes a little practice to set them up.
You got to do it the AG way. You got to do it the free juice way.
You got to do it the free juice way. And every once in a while you can get a back spread that's 3-1, and then you're doing the happy dance.
Then you're doing the Soros bag of money dance. I like it.
You are doing the Soros bag of money.
Think of the market we're in now, where you've got gold and oil moving a couple percent a day, and you say to yourself, I don't know where gold's going to be in a month, but man, if Syria blows up, $1,800. If the Fed does by the way, that's one person's opinion. It's not a market forecast, but you look at gold and you say, look, a month from now, under some circumstances, it's $1,800. A month from now, under some circumstances, it gets crushed. The Chinese are selling because their economy's bad. It's $900. And you say, well, I could buy a straddle. I could buy a straddle, but it's expensive. Instead, what I'm going to do is I'm going to sell the straddle, and I'm going to buy twice the number of wings on each side. And you look at it and you say, it's not a lot of risk, and it doesn't make money frequently. But, man, if something happens, they're rare events where these things make just bags of money. And the thing is, it's a very managed risk position. And of all the combination trades or multiple trades, in options, I think ratio spreads are about the coolest thing you can do.
I think we need to devote a whole show to ratios here because we clearly hit on Alex's sweet spot. I don't think I've heard you this excited in quite a while.
I'll bet you he stood up and gave that whole monologue.
Everyone at OX is looking at him right now saying, what's he gesticulating so wildly for over at his desk?
He's talking about something.
They don't look at me anymore. They just throw stuff. They just figured out that they throw stuff. And everybody who sits around me has requested to be moved to a private office so they don't have to deal with my emotional outbursts.
Yes, and the fancy hats, which block all their views. It's like being in a movie theater behind the guy with the cowboy hat. You don't want to be that guy. All right.
And also my favorite thing about the A Vega, can I just save money and buy the one?
Yeah.
That would assume you know exactly where the underlying is going all the time.
Yeah.
And hey, that would be great. As soon as I find somebody that knows where the underlying is going all the time, day to day, I want to start talking to that guy. You just haven't found him yet.
You didn't know that A Vega was the handle of Warren Buffett. That's why he knows such things.
Well, actually, I was talking to a client about how Warren Buffett trades, and what the thing was, okay, like I'm not comparing myself to Warren Buffett, just so everybody knows that. But the key to his success is he can always buy more, always, and he always buys at the bottom. He's awesome, but he always can buy more. And he always buys at the bottom, and he buys all he wants. He just does it like twice a year. Okay? But that's what he does. That's the secret. The secret is he never has to sell, ever, ever. He's never blowing out, ever. He's like, oh, that company's in the dustbin. I'll buy it all. Why? Because I got bags of money.
Bags of money. I think we've hit on a title. Many titles for this episode.
Think of Andrew's point. The benefit that Buffett has is the benefit that lots of endowments have and that pensions don't have. They are true perpetual investors. Another term demonstrating that I'm a geezer. But you think about the fact that if you are somebody like Warren Buffett or your Harvard Asset Management or Yale Asset Management, you can buy stuff and wait. You don't need to pay bills off any income, and you don't need to sell stuff. And that is the classic long-term investor trading business cycles. And, some people are trading weeklies. Some people are trading, quarterlies to get dividends. And some people are true perpetual investors. And that's what's so cool about the marketplace that we live in every day is it lets you trade all of those.
And unfortunately, this marketplace is about out of time, so we're going to keep on rolling right on into a very, very quick around the block and then finish this puppy up.
Around the block.
All right, listeners, if you were paying attention to this show, I think there's really two things from an options perspective that we're paying attention to for the rest of this week into the long holiday weekend. And that is, of course, the international perspective, the international developments, and how that trickles back into the options market. So if we'll see the weekend come out, we certainly will. But to what degree we'll really see it? When will we see it? Will it be early in the day? I think we'd wager here that it'll probably be very late, and it will be very, very, shall we say, mitigated to what we typically would see going into a holiday weekend where people are crushing every bid and they're really rolling the clock forward into Tuesday, if not Wednesday. This, I think, will be much more laid back, much more cautious. And like we said at the top of the show, I think this is a good opportunity to perhaps have some premium in your back pocket for that proverbial rainy day, because we are looking at a weekend where there is some quite literal weekend risk. You don't want to be that one guy who's caught short. Perhaps put on a nice back spread like our friend A Vega walked us through. As Mr. Alex said, there's bags of money in them there hills. Anything else you guys would like to add?
Big markets next week. Be careful.
There we go. Thin markets from the Viceroy. And that is going to do it for this extended but very fun episode of the Option Block. We'll have to do it just the three of us more often. Keep that Tusaw guy out of it. He's gumming up the works. And before we go, let's check in with each of my cohorts, my partners in crime, to see what they have cooking that may interest you. Starting with you, Mr. Andrew. What's cooking up there in the great state of Maine?
I'm pretty sure, but as usual, I'm not exactly sure, that Mark is doing a VIX seminar with the SIBO on September 28th. We haven't done a VIX seminar in 6 months. Again, 90% sure. Look for it at optionpit.com. It's not on our event page yet, so that's why I'm not sure. But I believe it is with Russell Rhodes. And again, showing people how that darn confusing VIX works. And that would be September 28th.
I love how all of your upcoming events come as such a surprise to you. It's fantastic.
It's the old joke about Alzheimer's. Every day's a new day.
There you go. There we go. I like it. And speaking of every day being a new day, what's coming up in the new days over there at OX, Mr. Alex?
A couple of webinars I'll showcase. September 3rd, option risk gauges at 1 p.m. Chicago. September 3rd at night. We do a lot of stuff at night for folks who obviously can't tune in during the day, but a short put webinar, 8:30 p.m. Chicago. September 4th, we talked about this a little bit today. Dan Gramza from the CME is going to talk about technical analysis in an algo-driven world. So a couple interesting topics. As always, there's a full webinar schedule. Come to the site, optionsexpress.com. Everything's free. The live presentations are free. The webinars are free. Lots of great resources.
Yep, that's it. Surf on over to optionsexpress.com. While you're there, open up an account. Tell them the Option Block sent you. They'll like to know that, and we will too. Of course, I joked earlier, Uncle Mike Tusaw couldn't make it, but if you haven't, surf on over to RCM Asset Management. You can check out all their upcoming webinars and the old webinar train, all the stuff they have cooking over there at RCM. And if you'd like to join all the rest of our listeners here who wrote in today, a lot of great ways to do that. You can surf on over to theoptionsinsider.com. That's, of course, where you could read all of the lengthier texts of those alerts and see exactly what people like Mr. Mike were asking questions about. And, of course, you can find us on Twitter or on Facebook. A lot of great ways to get us. And, of course, the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put the name of the show you are referring to in the subject line. And of course, it is a holiday week, so we won't see you next week for the Tuesday show, but we'll be back in 1 week on Thursday. So unfortunately, a shortened week next week from an Option Block perspective as well. I know there'll be some tears out there, but don't worry, we'll be back. And on behalf of Andrew and Alex and Uncle Mike, wherever he is, and of course myself, I want to thank all of you out there for downloading and streaming and subscribing to this program. Have a safe holiday weekend here in the States, and we'll see you back next week right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.